Bitfarms Limited is currently trading at exactly 2.58 USD, seeing a decline of 0.020 or 0.77% in today's intraday session as of this moment. The chart reflects a nervous chop, opening at 254, touching a high of 262, and now consolidating just below the previous close of 2.60. While the broader market might look at this minor red tick and shrug, the reality sitting beneath this price action is far more volatile and consequential than a simple percentage point drop suggests. You are looking at a stock that is currently caught in the violent crosscurrents of a Bitcoin correction, a massive operational pivot toward artificial intelligence infrastructure, and the lingering aftershocks of one of the most aggressive hostile takeover defenses in the mining sector's history. When investors look at Bitfarms right now, the expectation is straightforward. Bitcoin goes up, Bitfarms goes up. That is the standard correlation trade that has defined this asset class for the last 5 years. You expect that with Bitcoin hovering near historic highs, a miner like Bitfarms, which has aggressively upgraded its fleet and expanded into the United States, should be trading at multiples significantly higher than where we sit today. The belief is that the post-halving supply shock should have already triggered a parabolic run for efficient miners. But the reality is starkly different and far more uncomfortable. The reality is that Bitfarms is currently being priced not just on its ability to mine Bitcoin, but on its desperate and capital-intensive race to diversify into high-performance computing before its mining margins compress further. The market is not rewarding them for the Bitcoin they hold, it is punishing them for the capital expenditures required to build the data centers of tomorrow. This tension between the expectation of a crypto supercycle windfall and the reality of an infrastructure spending war is exactly why the stock is pinned at this $2.58 level, unable to break out despite the macro tailwinds. To understand why this is happening, we have to look at the immediate market mechanics driving this 0.77% drop today. It is not just random noise. We are seeing Bitcoin test support levels, dragging the entire mining cohort down, but Bitfarms is showing a specific kind of weakness related to its recent earnings performance and forward guidance. The volume today is telling a story of hesitation. Investors are wary. The company has been aggressively upgrading its fleet, swapping out older T21 miners for the more efficient S21 Pros, aiming for that golden efficiency ratio of under 20 watts per terahash. On paper, this is brilliant execution. In practice, it means downtime, unplugging machines, shipping logistics, and temporary dips in hash rate realization. The market hates uncertainty, and right now, Bitfarms is in a transitional phase where the operational metrics are messy. You are seeing a company that is theoretically more efficient than ever, yet the stock price is lagging because the cash flow required to fund this transformation is diluting the very shareholders it is meant to protect. This brings us to the contrarian take that most retail investors are missing. The general consensus is that the failed Riot Platforms takeover bid was a victory for Bitfarms' independence. Management fought off a hostile acquirer, adopted a poison pill shareholder rights plan, and maintained their autonomy. Investors cheered this as a sign of strength. However, I want you to consider the possibility that this victory is actually a heavy burden. By rejecting the acquisition and choosing to go it alone, Bitfarms now has to fund its massive expansion plans in Pennsylvania and Paraguay entirely on its own balance sheet. They do not have the luxury of Riot's massive cash pile or Marathon's gargantuan market cap to lean on. This independence means they must rely on at-the-market equity offerings, selling shares into the open market to raise cash. This creates a constant sell pressure, a dilution ceiling that caps the stock every time it tries to rally. The reality investors need to face is that independence has a price, and that price is currently being paid by the share count. Let's look deeper at the operational landscape that is forming this $2.58 price tag. Bitfarms is not just a Canadian miner anymore. It is becoming a hemispheric energy play. Their operations in Argentina were once viewed as a geopolitical risk, a liability due to currency instability and import restrictions. However, in a twist that defies the bearish expectation, Argentina has become one of their most reliable, low-cost power centers during the North American summer months. While miners in Texas are curtailing operations to stabilize the grid during heat waves, Bitfarms' South American facilities are running at full throttle in cooler temperatures. This geographic arbitrage is the company's secret weapon. yet it is rarely priced in correctly by algorithms that only track the price of Bitcoin. The market sees emerging market risk where it should see seasonal hedge. This discrepancy is where the opportunity lies for the astute observer who understands that global hash rate is a 24/7 game, not just a Texas game. Now, we must address the elephant in the room, the pivot to AI and HPC. Recently, Bitfarms announced definitive plans to convert valid capacity, specifically at their Washington site, to support AI workloads. This sounds fantastic in a press release. It puts them in the same conversation as Core Scientific or IREN. But here is the reality check. Refitting a Bitcoin mining facility, which is essentially a warehouse with fans, to host NVIDIA GB200s or sophisticated AI racks is an engineering nightmare. It requires different cooling infrastructure, liquid cooling versus air cooling, different redundancy levels, and different fiber optic connectivity. It is not a copy-paste job. The market is skeptical. That is why you see the stock struggling at $2.58, while pure-play AI data center stocks are soaring. Investors are waiting for proof of concept. They want to see the first dollar of revenue from a hyperscaler contract before they award Bitfarms the AI multiple. Until then, this is a show-me stock, trapped in the valuation basement of a pure-play miner trying to sell a story of high-tech diversification. Comment below how many shares of Bitfarms you currently hold, and do you think their expansion into AI computing is a genius move or a costly distraction from mining Bitcoin? We also need to discuss the specific macro pressures hitting the stock today. The global network hash rate is at an all-time high. This means the difficulty to mine a single Bitcoin has never been harder. For Bitfarms, this means they have to run faster just to stay in the same place. Even with their fleet upgrades, if the global network grows faster than their own deployment speed, their slice of the Bitcoin pie shrinks. This is the relentless mathematics of the protocol. The expectation is that a bull market solves everything. The reality is that a bull market attracts more competition, more rigs, and more difficulty, compressing margins unless the price of Bitcoin goes parabolic. At $2.58, the market is pricing in a scenario where Bitcoin drifts or rises slowly, a scenario where Bitfarms survives but does not thrive. It is a pricing model based on caution, ignoring the potential for a supply shock squeeze that could send the stock vertically if Bitcoin breaks its own resistance levels. In terms of actionable data for traders watching this script right now, you need to be aware of the short-selling dynamics at play here. Bitfarms has attracted significant short interest, often hovering around that 15 to 20% of float range. This is not just retail pessimism, this is institutional hedging. Hedge funds will often go long Bitcoin spot ETFs and short the miners as a way to capture the spread or hedge against operational risk. What you need to watch for is the borrow rate. If you see the cost to borrow Bitfarms shares spike on your brokerage platform, it indicates that the pool of available shares for shorting is drying up. This is often a precursor to a short squeeze. When the borrow rate is low, shorts are comfortable. When it spikes, they get nervous. Currently, the short thesis relies on the idea that Bitfarms will continue to dilute shareholders to fund growth. If the company announces a non-dilutive financing source, like a major debt deal or a prepayment from an AI customer, that short thesis collapses instantly, and the rush to cover could propel this stock through the $3 and $3.5 resistance levels in a single session. Furthermore, keep a close eye on the failed-to-deliver FTD data that comes out bi-monthly. A buildup in FTDs can suggest that naked shorting or administrative failures are stacking up, creating a coiled spring of buying pressure that must eventually be released. Retail investors often overlook this, but in the small-cap mining world, FTD cycles often correlate with sudden, unexplained, violent upside moves. If you are holding the stock, you are essentially betting that the shorts are wrong about the dilution death spiral. You are betting that the new management team, led by Ben Gannon, can bridge the gap between the capital-intensive upgrade cycle and the cash flow positive promised land without destroying the equity value in the process. Let's shift focus to the company's financial structure, which is often misunderstood. Bitfarms carries debt, but they have been aggressively deleveraging over the past 2 years. The expectation from the ghosts of 2022 bear market is that miners are debt-heavy zombies. The reality for Bitfarms is a much cleaner balance sheet, but one that is now being re-leveraged slightly to fund the AI expansion. This is good debt if it generates high-margin AI revenue, but bad debt if those contracts fail to materialize. The market is currently treating it as uncertain debt.
This is why the stock trades at a discount to book value compared to some of its more hyped peers. If you look at the price-to-book ratio, Bitfarms often looks cheap, but value traps also look cheap. The difference here is the underlying asset, a massive portfolio of power contracts. In a world starved for energy, having hundreds of megawatts of secured power is a tangible asset that doesn't depreciate. Even if the mining rigs go to zero, the power contracts in Quebec, Washington, and Paraguay have immense intrinsic value. The market is ignoring this energy infrastructure floor price and focusing entirely on the crypto volatility ceiling. It is also vital to look at the regulatory environment. Bitfarms operates in multiple jurisdictions, and this diversification acts as a buffer. When legislation in the U.S. threatens an excise tax on mining, Bitfarms can point to Canada and South America. When Canada gets strict on energy use, they point to Pennsylvania.